As I've said, my name is Tayo Olatimilei, and I have here assisting me today my wife, Oluwaseyi Olatimilei. Okay, she'll be the one sending the text to you. Okay, the first we're going to do is a disclaimer. This is required to be done for any training institute or anybody who is just offering training in United Kingdom where I live. Today's discussion is a presentation and is for education purposes only and should not be construed as investment advice. Investment can go up and down in value, so your return could be less than you put in, as past performances do not guarantee future returns. Before making any financial decision, make sure you consult with a licensed financial advisor. Okay, thank you. If you're able to, I believe you can all hear me, or if you cannot hear me, can you let me know? Or if you can hear me, rather, can you give me a thumbs up that you're able to hear me? If you join as a panelist, you can use the emojis. So you can please give me a thumbs up. Yeah, okay, I can see that. I can see those things coming up. Thank you very much. Now I know you can hear me. Okay, to start with, what are we about? KWC Global Institute is dedicated to coaching on leadership and empowerment, and that's our focus. We want to teach on leadership and empowerment. And for what reasons? For us to achieve profitability in every area of our life. And then the acronym is LEAP, for us to leap in life, either in our family, in career, in business, in relationship, in finance, and spiritually. And that's what we are dedicated to as a company. And this was born out of, what's spoken into our lives. I'm here standing on the shoulder of giants who have encouraged me to go ahead. I'm sure you hold them a lot because otherwise we won't be here speaking today. And so I thank the Lord for my pastor and for my wife who have encouraged me to do this. Okay, and that's our website there. And the flagship training that we are starting with, which is what we are attending today, is called the Building Wealth for Generations. Building Wealth for Generations. And that's the flagship training that we are starting with. And this has to do with training, hacks, tips on personal finance and on investment with the hope, with a vision in mind that you want to build wealth and be able to transfer the wealth to the next generation. So what we are trying to do is to give them a pedestal to pave the way for a prosperous future for those who are coming behind us. Regardless of your age, whether you're young, you're an adult, you will find something useful in this. And we'll be able to, teach you things that you can do in order to do so. I'm not your average YouTuber, like I tell people. I'm also on this journey, okay? And over the last years, half a decade or more, and in fact, over a decade, I've been able to put to use what I'm going to show you today. So I'm not teaching you theory. Everything I'm telling you today are things that I do myself, okay? This is not a pump and dump. It's not a get-rich-quick training. No, it's you being able to build wealth from the ground up, regardless of where you are right now. So the goal is to equip the next generation every way we can, okay, passing on substantial wealth and education for them to sustain it. It's not enough to give so much to our children, but the education to sustain it is what matters. You don't want the third generation to squander everything you've acquired, okay? There's a need for us to sustain this through education. And then you're going to have a comfortable retirement if you follow this. We're going to probably be able to pay off our children's expenses for the college. They don't have to incur debts. But beyond that is that we're also passing up substantial wealth to them. We have the course outline there. I won't bother going through that. We've already seen that on the flyer. And about me, I am an IT consultant. That's my 9-to-5 job. But I also train people in career development, and I train in financial investment like we are doing tonight. I have an MSc in business strategy, leadership, and change, and a certificate in digital transformation and other certifications in line of my career. So what's our motivation? Like you have here. Before now, I thought someone raised their hand. Okay. Okay. Let me see if I can unmute you, or if you can type that question. That's okay. If you okay, can you go ahead, please, Aramide? Okay. I guess that probably might be you trying to indicate to me that you can hear me. I will take it as that. Okay. So I thought, investing in the stock market, making big money is not for people who do 9 to 5. You probably bought 1 or 2 shares before, but I've come to realize after starting with £100 years ago, investing, that you can actually be able to multiply and have substantial wealth doing what I'm going to show us today. And so that's our motivation, that every one of us, we are able, over time, to be able to build substantial wealth doing this. And that motivation is to see us, every one of us, that tomorrow you're comfortable in your retirement, you're able to pass substantial wealth to people who are coming behind you. And I wish I'd known this very long time ago. And as you see in the next slide, I'm not a novice to the platform of investment. I opened my first account in 2006. That's quite a long time ago. But I put here that trading versus investing. What are the differences? I was trading. I was not investing. And today I will show us a few differences between doing either of the two. And our focus today is investing and not trading. We don't trade currently, and I don't encourage people to do so for reasons I would explain to us as we go along. So generational wealth is all about being able to transfer assets that you've acquired to the next generation. We have a list of companies of families there who have been able to perpetuate wealth from generations to generation in their billions. And I'm sure we can do the same thing at our own level. Okay, why are we doing this? Okay, why have you not been doing this? Some people think they don't earn enough to be able to invest. I beg to differ, because these days, with as little as £25, you can start investing. Okay, as little as £25, and in fact, as little as £10, you can start. You can open an investment account and start investing. Okay, some will say, oh, I'm in debt until I pay it off. But again, I will show us the reason why we don't have to wait when we clear off all our debt before we start investing. It's an habit that we need to form. And the earlier we form it, the better. So there are a lot of reasons there. Some people say it's too hard. I don't understand it. When I say the chart is confusing, how do I know the company to pick? How do I know where to put my money? Some will say it's too risky. I've lost money before. Somebody invested for me, or I invested for myself and I lost money. Some will say I'm too busy. I'm too busy to be able to do it. I can't go on the platform on a daily basis. But you don't really have to. Some will say I've already have a pension contribution at my place of work. So why do I need additional contribution? You need to know that people are living longer, and the pension companies are carrying a lot of load that they, is that we have to work longer till we are 70 or 70 something before we are able to access our retirement, or we have something by the side like I'm trying to show us today. Some would tell you that the system will take care of my children. So I don't mind. They should go and borrow and live their own life. I'm living my own life. But I'm sure we can do better. Some will say tomorrow will take care of itself. I just want to enjoy it today. You can also enjoy why you are in this process. You don't have to put 100% of your money into savings or your investment. So what are your reasons why you've not done this before? And if you started this, you're on your journey, that's very good. We'll be able to also learn from you. Some people will say, are we investing out of fear? Why should we invest? Some will say, I'm a Christian, God will take care of me. But if you read our Bible very well, we also know that there's a need for us to prepare for the future. He said we should go and learn from the ant. From the ants will keep their food in summer against winter. Okay? And he says it says the last bullet point says, he who gathers during summer and takes advantage of his opportunities is a son who acts wisely. But he who sleeps during harvest and ignores the moment of opportunity is a son who acts shamefully. And I'm sure we want to act wisely. So it's not about fear, it's not about worry, it's about you taking control, being in charge, providing leadership, and being a good steward to what God has provided for you. So it is the will of God for us to prosper for us, and there's a need for us to take responsibility, because God won't do for you what you can do for yourself. And you can see the highlight in red. It says, I am from a poor background, hence at 30. Yeah, it's no longer an excuse for you to say, I'm from a poor background once you clock 30, because from there, you become the background. You are now the background on which people come behind you can build a future. So you're a good steward if you do this, and then you are respecting the law of seed and harvest, because the world is sustained by the law of seed and harvest. And part of what you earn is yours to keep, because part of what you earn is a seed, okay? And so on. We can see the reason why we need to do that. I'm only because we have a lot of slides to go through, and I want us to get as much as possible. So the essence of today is not just to excite you, but I want after today that you will start on that investment journey right away, okay? And then we have here a list of first generation billionaires who built wealth almost from nothing, okay? And then we have here, how can you become a millionaire? There are different ways you can become a millionaire. You can be gifted, you can play lottery, you can be executive of a multinational company. You can start a business like we see in the other slide, like people that who are investors today, who are businesses, who are billionaires. But there's one thing that we can all do. You probably might not inherit anything, become the CEO of Microsoft or Apple. You probably might not have the enthusiasm to start a business, but there's something that you can do. You can become good at what you do right now and let your money work for you. Every one of us can do that, regardless of your line of profession, whether you're a cleaner, whether you are selling pepper ingredients, whether you are a doctor, you are an IT consultant like myself, or whatever, or you're a teacher, whatever you are doing right now, you can become very good at it and make your money work for you. So for every one of us on this platform today, regardless of our level of earning or what we have chosen as career, we are able to build wealth, okay? And the first thing we look at, as you have on the flyer, is the 7 pillars of building generational wealth. The 7 pillars of building generational wealth. What are those? We have them listed here. I will quickly go through them one after the other so that we can go into show you a few things on how to get started on this journey. And the first thing on there is our mindsets, and that is the foundation of building wealth. So if you go on courses, they will teach you about psychology of money. They will teach you about your mindset. Poverty is not the absence of money. Poverty is in your mind. It's a mindset. Not having enough is a mindset that we need to change. Okay, because people move from 1,000 a month to 5,000 a month, and it's still not enough. Okay, people move from 5 to 7 and they think, where is this money going? It's still not enough. So it's a mindset that we need to change. Learned helplessness is a mindset that we developed over time. There's a need for us to consciously change that. So that's the first foundation for us to be able to build wealth. Be comfortable with wealth. Don't resent the rich, okay? Because you too can be that person tomorrow. Okay, so we need to know that God wants us to be rich. If you are of faith, if you are spiritual there, and if you are not spiritual, you know that wealth to be rich is very good. Okay, and when you have that, you also see it as a responsibility that you have a responsibility of leadership to leave wealth for the next generation. If you see that as a responsibility, then you'll be able to work towards it. Okay. For those who are just joining us, probably might be invited to become a panelist. It's not for you to come and speak, but for you to be able to interact with us better. Okay, you can please accept that invite to become a panelist. Okay, so I'll move to the first pillar. So that's the foundation of the pillar. So the first pillar for you to build wealth is financial education, which is something that you're having right now. Some of you have been to a lot of seminars in the past. That's very good. You've read books. That's very good. I want us to start doing. So what I'm doing today is to take us to the point where you take that very step. So I was discussing with somebody not so long ago. He said, I have the account, I opened it, I put money into it, but I don't know exactly how to buy the first one. Okay. And I was able to pull the person through. And so you could be in that position. So there's a need for us to educate ourselves so that when you see an opportunity, you know that this is a good opportunity. When somebody is coming offering you 25% on a monthly basis, you know that this person is probably trying to scam you because you don't have such investment anywhere in the world. If they have it, they will only put their family there. They won't invite you to come and join them. Okay? It takes a trained eye to spot an opportunity, either the good one or the bad one. Okay? Education increases your confidence to be able to do invest and to be able to. And how do you get the education? Is through training like this, through mentorship, leveraging on other people's experience, and through books. And I put a few books that I've read. I've read more than that, but these are very foundational, and they are very good books that I will encourage any one of us to pick one and read. Next Door Millionaire is very, very interesting. Rich Dad Poor Dad classic over the years, over the decades. Rich Man in Babylon, very, very good one. Okay, second pillar is that you need to secure a source of income. Okay, you need, no matter how small that income is, you need to be doing something, and that is your seed. So whatever you are doing, that becomes your seed. First of all, the first pillar to building wealth is that you don't wish it, okay? You go get a job, get something doing, get a business started that can put money into your hand. And anything that comes into your hand, you have two things. Either it's both a bread and a seed. You understand that from the Bible. Anything that comes to your hand is both a bread and a seed. And so you have seed in it, you have bread in it. It means that anything that comes to your hand, you don't eat everything. You keep a little bit aside for you to be able to sow. And in that pillar, you must work to protect your income. You don't just protect it, you advance in your career. You keep moving in your career so that you increase your capacity to be able to earn. You get trained and retrained in your career. You follow a path not everybody is following in your career so that you can increase your value, so that you can have value and be able to increase your earning. And I put a quick slide here of how I've been able to take that journey from being a warehouse operative about 15 years ago to becoming a consultant and self-employed IT consultant today, and what I can do even after then to be able to increase my income. So in this country, some people take home 1,000 a month, some people take home 20,000 a month, because some people take home 10,000 a month. We all spend 8 to 9 hours doing our job. Okay, what is the difference? You need to be able to retrain yourself and move on in whatever line of career you've chosen. If you're a teacher, you can become a curriculum developer, you can become a consultant to other schools. Whatever it is that you've chosen to follow it to and become a professional in it. Okay, so very few will become a millionaire working 9 to 5 jobs. That's a little bit sad, but there's something you can do, can make your money work for you 24/7 to become a millionaire. Okay, the next one is pillar number 3, which is financial control. I mean that when money comes into our hand, you've gone out, you're earning, you must be able to control what comes in. Don't let your income control you. Control your income. Resist what is called lifestyle creep. Lifestyle creep means your reasonable expenses will always grow to be equal to how much you earn. So if you're earning 1,000, your reasonable expenses will be 1,000, 1,001. If you're earning 2,000, your reasonable expenses suddenly becomes 2,000, and you don't even know how. When you move to 3,000, 5,000, 10,000, your reasonable expenses suddenly becomes 8,000, 9,000, and 10,000. Okay, it's called lifestyle creep. Okay, you think, oh, I should have this, I should enjoy this, I should have this. I think it should be bigger, it should be, it should be sweeter. And your lifestyle will creep to be equal to your income. And before you know it, you have to borrow to be able to satisfy that lifestyle creep. Okay, so there's a need for you. How do you control your finances? There's a need for you to do budgeting. And when I mean budgeting, you need to be able to consciously say, I allocate this to this, and I allocate this to this. And for my savings and investment, I allocate so amount. And then from day one, when you get that money, that whatever is going to your investment or into your savings is getting out of your account from the first day of the month, or from the first day that you receive your salary, it's out of it, and the remaining one is now there for you to spend on other things. The common saying that you should pay yourself first. Okay, it seems funny, it seems kind of cliche, but you have to pay yourself first. You pay the supermarket where you are buying from, you paid your landlord, you paid your mortgage, and you think that the food you eat is how to pay yourself. You should pay yourself more than just what you eat. That's not what you pay yourself. What you pay yourself is the seed out of your salary. It is seed out of your income, which you put aside so that it can generate more seed and more bread for you. So I just put on the board here just a few examples of allocation of resources following the 50-30-20 rule, which is a very common rule of where you put the 50% of your income into necessities, things that you can't do without. Okay, you have to transport yourself to work, you have to live in an accommodation, you have to eat, you have to take care of your children. They are very important, 50% of your income. Okay, 20% of your income are on variety of expenses that are discretionary. Okay, they are not a must. You can do without them, but you are doing them anyway because they are discretionary expenses. And then you have remaining 20% are committed to savings, to investment. Or if you have a loan you are paying back, you are also using part of that to do that. Okay, and so that is the third pillar. So the fourth pillar for building wealth that must be in place that you can't joke with is that you have to now be strategic about applying the seed that you have kept back to build wealth. You want to be strategic about building wealth and about investment. And we listed here the things that you can do. It could be investment in stock or money market. It could be investment in real estate. It could be investment in businesses. Some of us have a flair for business. Anything you touch turns to gold. It could be selling. It could be a structured business, whatever it is. You now need to be very strategic about building a business, automating your savings, not letting anything, don't letting anything disturb what's supposed to be your seed. Okay, you avoid personal debts, and that is the next pillar, and that is the core of what we are looking at today: building wealth with whatever you have put aside. Okay, I will go to the next slide. The next pillar is wealth preservation. I'm running so that we can go through the slides. I've got quite a number of them. The next pillar is that you have to be able to preserve what you have acquired. You have to be able to preserve your wealth. And you have to understand what risk management is all about. And what is that? You need to understand what it is to have a portfolio diversification, a diversified portfolio. You need to know how to balance your portfolio. You need to know how to what risk you take at what age or at wherever you are in life. You need to seek tax advice from people who are professional in that line. But very important is the area of diversification. So diversification, you have it in levels. You can diversify within a particular sector. You can do cross-sector diversification. You can do geographical, cross-geography kind of diversification. So all of this you need to know in order to be able to manage risk. And people will call you, asking you that they can invest for you. Okay, that is common, that people will call you, don't worry, we are in London, we do this, just give us the money, we invest for you, we trade for you, we do this for you. I think the answer is that, go and help yourself. Don't help me, I'm fine. So people will come around trying to steal from you. You should be able to manage such risk and protect whatever you have built over the years. So you must be able to assess your risk appetite and be able to know what to do to mitigate even when you are taking a bit of risk. For me, anybody who is offering more than 10% per annum, I just say no. And in fact, I undo my investment myself because I've lost money, somebody trying to make money for me in the past. And so I just tell you, I will do it myself. And anybody who is saying 15, 20, 30, 100%, no. You just say no to such a person. Okay, but taking control of it yourself is the most important thing. Pillar number 6 is succession planning. Okay, and that has to do with educating the next generation, being able to transfer the wealth in a tax efficient manner, having a will, having a trust, bringing your children into shareholding into the company that you have, that you have a property investment company, or you are starting a business, being able to bring them in, educating them to know how to work the business, having a family office. This is an office where everyone within the generations, 1, 2, 3, 3rd, 4th generation, are going to get financial advice. They handle their investment for them. They manage their portfolio for them. This is the area where you really want to get to. And so you must put in place that pillar number 6, which is the area of transferring wealth. So you build wealth, you multiply your wealth, you preserve your wealth, and you should be able to transfer your wealth. These are the pillars. So pillar number 7 is the charitable giving. And it's good you give to a cause that touches your heart. Okay, there's blessing in giving. And then I have a link there that shows the list of people who we regard as captain of industry today, and we can see how benevolent they are. Some people think they are giving back, they are just being generous. And you can be the same thing to people giving as much as 46 billion in their lifetime, people giving 33 billion, and so on and so forth in this one lifetime. There are things that are precious to you, there are things that are close to your heart, then you should be able to also give towards it. It is, there is a blessing in it when you do that. Okay, and so those are the 7 pillars. The foundation is what I will go to a summary page where I've summarized it. So this is the summary of it. Your mindset is the foundation upon which this pillar stands. Okay, your financial education, securing a source of income, having financial control, tight control on what comes in. Okay, building wealth itself, which is the core of that pillar. Okay, and then you have wealth preservation, you have succession planning or wealth transfer, you have charitable giving. Anything you now put, like we have the roof, anything you put on these pillars will be able to stand the test of time. Okay, anything you put on that pillar, be it real estate, be it stock investment, be it entrepreneurship, be it angel investing, whatever you put on that pillar will be able to stand this test of time. Okay, the next thing then is you mastering the 5 phases. And the phases, they are not in sequence. You can be in multiple phases at the same time, as I will begin to show us. So the phase 1, of which some of us might be in phase 1, some of us might be in phase 2. I think I'm in like phase 3, going to phase 4, as I will be explaining this. So your phase 1 is you understanding money, having a mindset reset, and breaking old habits. If you've not been putting money aside before, it's time you want to form a new habit of putting it aside. If you're putting it aside and you go back there and take it after 6 months because of pressure here and there, there's a need for you to break that habit and be able to put it into work for you as soon as you put it aside. Okay, husband and wife, if you're married, if you do things together, it's always good to be on the same page, to be able to also, it's part of the things you do in phase 1 as you are getting results. Becoming debt-free is what you also do on your phase 1 to building wealth. In this particular phase, within 24 months or so, within 2 to 3 years, you want to be debt-free. Okay, it means you are allocating a particular amount to paying off any outstanding you have. And then you are putting aside, first of all, even after this class, you want to have a strategy in place to put aside at least 1,000 into your reserve fund. Why do you have to do that? That prevents you from going into your credit card. That prevents you from borrowing, taking a personal loan. Okay, you going out, you have a tire puncture, maybe if you drive a big car and your tire is 300 pounds per tire, you don't want to just go into credit card and go and pay for that. You want somewhere where you can pay for it. Something is damaged in the house, you need to fix your toilet. Okay, you don't want to use a credit card for that. You want to go into that fund, take a little, use it, and replenish it back to 1,000. So you want to form that habit of not falling back on loans, on overdraft, on credit card, in order to be able to fix small emergencies and things that normally come as part of life anyway. And so you're developing new habits, habit of paying yourself. You're developing that in your phase one of building wealth. You've opened an investment account to put that money you pay yourself into. This is where you are laying foundation to be able to build wealth. Now we move on to second phase of building wealth. Okay, at this point you are consistent. You build consistency into your, you build a contingency fund of up to 3 to 6 months. Okay, and why do you have to do this? You could be out, you can be in between job. There could be reasons why income is not coming in. Then you have something to fall back on. You are not 1 or 2 events away from becoming homeless or going into credit card or borrowing. So you have a reserve fund. And so once you are done with paying off your debt, you have a consistent saving culture. You have to build a 3 to 6 months buffer. That if I don't work for 3 or 6 months, I have something to be able to take care of myself and my family. Okay, you need to increase and automate your saving to at least 10% of your income. So we are going to 20. But at this point, you're able to automate your minimum saving should be at least, in phase one, you are building an habit. It could be £100 or it could be £5 you're putting aside on a monthly basis. But when you get to this level, a minimum of 10% of your income is going into savings. You're seeking mentoring to understand what you're trying to do with your money. You are consolidating your investment. If you already started investing in phase one, maybe you have 2 or 3 shares of individual companies, or maybe all you did in your phase one is mutual funds, ETFs, index funds. But when you now get to phase 2, you're able to now start diversifying. Maybe you were doing technology alone before. You're now going into financial stocks. You're going into oil and gas stocks. You're going into consumer goods, consumer staples. You are going into different sectors of the economy. You are beginning to diversify your portfolio. You are opening an investment account for your children for their education, an investment fund for their education, so that by the time they are 18, they don't go to school going to borrow money. You already have that sorted out. That's what we begin to put in place when you get to phase 2 of building our wealth. So these are things that you can start taking off. That I've done this, I'm here right now. You can see it as you go along the phases. Okay, you're also able to formulate an investment strategy when you are in your phase 2. And it's right from an investment philosophy which you get in phase 3. Okay, in phase 3, you have a higher level of diversification of your portfolio. Like I've explained, you're moving into sector, you are doing other instruments apart from shares and funds. You're doing real estate, you're moving into dividend paying stock. Not all stocks pay dividend. And the reason why some pay and some don't pay. If I have the opportunity, I will explain that to us just in a moment. Okay, in phase 3, you now have a good understanding of a good and a bad investment. When you look at a stock, you're able to say, okay, I can buy this stock, or everybody is buying it, but I will not buy it for so reason. You have a philosophy of what to buy and what not to buy. And when you have a conviction or an investment thesis on a particular stock, you stick with that philosophy. Okay, you are paying off your family mortgage home as quickly as you can, and then you are now moving to 15 to 20% of your household income that you are putting into savings and into investment. That is phase 3 of you building wealth. And phase 4 is when you now go across geographical boundaries to be able to build your wealth. You have real estate in America, you have real estate in Africa, you have real estate in Europe, or you have shares in Australia, you have shares in Asia companies, American companies, European countries, you're becoming an angel investor. You are putting money into startup company. You're looking for multiple streams of income. Okay, and you are doing this because you now have the experience and the financial education to be able to diversify at that level. Okay, you are doing estate planning, and then you are putting up a foundation to manage the things that are there to you. Okay, and the last phase is phase number 5. Okay, and this is you mentoring and allowing the next generation to do the thing where you sit back and watch them and guide them, setting up a way to sustain and to put continuity into what you have started. You are in your retirement, you are mentoring, you are enjoying that phase, and even along the line, you also enjoying yourself. But at this point, that you are retiring young, you are retiring rich, you are mentoring the next generation, or you still have the strength to do so. Okay, and those are the 5 phases that you go through while trying to build wealth. Like I said, not in a particular sequence. It could be in 2 of them at the same time, but these are ingredients that you need to tick off. Have I done this? Am I here? Have I done that? Okay, while you are trying to build wealth. So putting those 2 things out of the way, I will move on to the next thing. If you do have any question, you can put in the chat. And if you've been invited to join the panelists, join. You're not being invited to come and talk. It's for you to have full access to be able to interact during the webinar. Okay, during this training, you're able to ask questions either using audio or using the chat. Okay, the next thing I want us to look at as we start this journey of building wealth is the cash flow quadrant. Okay, the cash flow quadrant. Okay, this is talking about the EBSI. Some of us are familiar with it. It was developed by Robert Kiyosaki, and you have the link, the source of it there. And then there's an explanation to it, which I'm going to explain to us. The E is you being an employee. The S is you being self-employed. The B is business, and the I is investment, as you can see. And the next thing here, which I'm going to explain to us, is this is the explanation of the quadrant. And it's good that we understand it. Then we will know the flow of money, because the quadrant represents the flow of money as you develop in your career. So you probably start out as an employee somewhere. Some will start out as a business owner right out of school, or that's what they want to do, and they are doing that right now. But a lot of us are started out as what? As employee. When you are an employee, your money equals to your time equals to money, and you just do have a job. What you have is that you got a job. You have no leverage, but you have an income, which is a good thing. So when you're an employee, your income can go into the high quadrant. Okay, you can move money from E into high as an employee. You can move money into E into B as an employee. So the next quadrant is the self-employed quadrant. If you are there, you still own a job, even though you are a consultant. You are this, like for myself now. If I don't work, I don't get paid because I'm self-employed. Okay, I only get paid when I work. So I own a job. You don't own a business yet. Though you don't have a job, but you own a job. Your time is still equal to money. It could be more money for you, but your time is still equal to money. But when you are this, you can put money here. You can put money here from wherever you are. Some can remain here all their life, but they are putting money into the high quadrant, and they can still become wealthy doing that. They can pass on substantial wealth to the next generation, even still doing that. And then, but what you want to do is to move from this quadrant to come to this quadrant. Okay, become self-employed, become a professional, become a consultant. Okay, and there's a saying that if you are employed, if you are an employee today, you are in business, but your only customer is the person that employed you. It means you can multiply that and have more than one employer, as in form of customer. Your first customer is your employer. It means you can now have, you can use that same skill and have multiple customers that you can work for. And that's when you become self-employed, or when you set up a business to become a business owner. You have an accounting firm. You can now have 2, 3, 4, 5, 6, 7 you are auditing for, as against you just auditing for your employer. You now have an hospital, you have 1, 2, 3, have people who are coming in. You are now an IT consultant, you are consulting for small and medium scale company, okay? Or whatever it is, you can now multiply that and build a system into which you can own a business. At that point, you are leveraging on people, okay? And when you are in any of these quadrants, you're able to put money into the investors quadrant. The investor quadrant is the only place where you really earn passive income, where your money go work for you. Okay, you have a job, you own a system, and then this is where your money actually work for you. So an understanding of that means that you don't have to quit your job to say, I must start a business. It's good if you have enough money to sustain you while doing that, or you can be here or here, and you can make your money work for you. So that's the moral in the cash flow quadrant. You see money moving around the 4 quadrant, and when you do that, you are leveraging. Just like buying real estate. If you have 100,000, you can buy a real estate of 1 million, and that's called leveraging. Okay, your 100,000 can give you a 1 million pound real estate if you are in the UK, for example. Okay, leveraging is you using other people's money, knowledge, wisdom, influence, and other people's money to be able to multiply wealth. So the next thing I'm going to look at is compound interest, time and compound interest, and how that can be can work for you or can work against you. But you want it to work for you by you understanding how compound interest works. Okay, so someone called it the 8th wonder of the world. It's a compound interest is the 8th wonder of the world. He who understands it earns it, and he who doesn't pays for it. If you don't understand compound interest, you keep paying compound interest on your credit card, and they tell you to pay just maybe 1% of the outstanding. It's just a trick so that you can pay more and more as the money compounds, okay? Because the interest is added to the capital. And Warren Buffett confessed that his wealth has come from a combination of living in America, some lucky genes, and compound interest. And so we're going to do some practical now. I'll put this link in the chat for us. You can open to it if you can open to the link. Okay, Microsoft won't let me do that. So let me just minimize, and I'll copy the link and put in the chat for us. Let's play around with a compound interest calculator, and that is just to show you what it is and how it could multiply your principal, which is your initial investment. So I'll put that in the calculator. There are quite a number of them out there, but this is my favorite. Okay, while doing that, if you're invited to be a panelist, please accept. It's for you to be able to interact better with us. It's not, we are not asking you to come and speak. So I will also put that link into a web page. I will open a web page now. I hope you can still see my screen. Okay, so I'll put that there, and then I'll put up. Let me share my PowerPoint again. Again, I'm juggling those two together. You should be able to see my PowerPoint now. I'll go to the next slide. Before we do that, so someone asked during the last class that he said, can compound interest really work for stock? And I told the person the answer is yes. So I decided to put a slide together to show how that can be possible when it comes to investment. And I did the calculation. I arrived at the same answer using the compound interest formula and looking at investment. So we're saying, let's assume that this year you put in 1,000 into investment, and at the end of the year, you have a 10% return which is the standard we are going to use all through this training. So your return is £100. And then so at the end of year one, you have 110. And you put that 110 to work again for another year at 10% return. Your return on that becomes 110. Okay, and then if you add that 110 to what you have from the beginning of year two, becomes 100, 210. Put that to work for the following year, and there's an increase of 10% on your portfolio. So you have 121 increase. If you add that to what you started with in January, you have 1331 to start with in year four, and at another 10% return, you have 133 as your increase or return in year four, and you start year five with this amount. At the end of year five, you have this return on your investment. In total, at the beginning of at the end of year five, you have 1,610. And putting that into a formula here, you also have come around to the same thing. So compound interest can work for your investment portfolio. So let's look at a few examples. So I put in a few examples here. Let's assume that you have a child, just giving birth to a child, maybe today or in the last few weeks or few months, or your child is 1 year or 2 year old. Just going to use this as an example. So a child that's age 0, you start an investment of 1,000 for the child, and you put in £200 on a monthly basis for the child. By the time the child is 18, period is 18, going to college, 16, 17, 18 thereabout, that child will have 126,000 in their investment portfolio. And in the UK, if you do this, it is tax-free. Nobody will take any tax from that amount. And like I give an example during the last training, that with this, that child can pay off their school fees, they finish college, university without having to incur a single debt. And in that, out of that money, you can buy an apartment for them in the university city, where they become a landlord from their year one, and they can become a landlord to their mates and start collecting rent. And their mates are the one paying the mortgage for them. And by the time they leave that city, that house can be there for them as their first investment property, even as a 21-year or 22-year-old, they're already in that property ladder. And then I've given those scenarios if a person, and that's for an ISA, a junior SIP, it's an investment account in the UK. And then if you put in from age 0, you put in 1,000, 200 every month. By the time they turn 18, you give them the account, they continue with the 200 every month. By the time they are 55, they already have 5 million in their account. They can retire at 40, for goodness sake. They can retire at 50, for goodness sake. That's because you laid that foundation for them. And I'm sure a lot of us can put away £200 on a monthly basis and not know we've put away anything at all. Okay? And so let's go to the calculator now, and I will simulate a few things that I've already put in here. So I'll bring up that web page, and then we can just simulate a few of those things. Okay, you have that child, is got a naming ceremony gift, whatever it is, and then you have 1,000, and then the period or the interest rate is 10. And the reason why I use 10 is because S&P 500 is Standard & Poor 500. It's an American index, and it comprises of the top 500 companies in America. It has returned at least between 8 to 10% in the last 75 years, okay, of people tracking the record. It has returned between 8 to 10% on an annual basis. And so that's the basis which I normally work with. If for 18 years, and then you put in a monthly deposit of 200, and if you do that calculation, what you are going to get is this amount. You actually put in, that changed to 17, 18. You've actually put in 43,000 is what you put in, but compound interest has given you 81,000 interest on that money at 10% return, compound interest return on a yearly basis. This is a yearly return, a 12-month return, not a monthly return. You have 100 on this. And if you hand over the accounts to your child, when your child is 18 or 20, when they have their first job, and they do that until they are, let's say 55, 18 from 55 will be how many years? That's 20 from 5, that's 30, and that will be 37, am I correct? Okay, about 38 thereabout, or maybe thereabout. So if you do that for that child, that child sorry, it should be 55, sorry, because they continue from there. You started from age 0 to, then they continue from age 18 to when they are 55. They have 5.9 million in that account when they are 55. Before they are 55, let's assume they stop at when they are 40, or let's say when they are 45. I think 2 million is still a very decent retirement for anybody to be on. And so on and so forth. And if you're already, let's assume you're already 30, you are starting with 1,000, and you are 10%, and you want to do it for the next, let's say from 30 to 55, and that would be, want to do it for another 25 years when you are 55, or even at retirement when you are 65, at 200 on a monthly basis. What you are going to have is you're going to have this should be not 55. You're 30 right now. That's 35, and then so what you have there is you have 700,000, almost 800,000. And this is minus dividend that will be added to, that you are making out of that money, that will be added to your capital for you to generate more wealth. And so this is very possible. What does it take? It takes consistency. It takes you being able to know what to put your money into. And then we know that historically our market has returned that much on a yearly basis. So I'll move on to the next thing quickly. Okay, so the next aspect is that I picked a few stocks to use as an example, using what will be your return if you had put 2,000 into Apple 10 years ago. You probably was able to afford a $2,000 Apple, a $1,000 or so Apple phone 10 years ago, or maybe 5 years ago. If you had put that money into Apple stock, what will be your return today? And so I'm going to share these two links with us. It's something you can play around with after this. Some of these things changed my perspective and got me started into investing, just like it did for Warren Buffett. It was compound interest that that stimulated his interest in investing, and that's what stimulated my interest in investing. And I've never looked back since I discovered that power of compound interest. Okay, so I've got a few ticker here, and I'm going to put one of the links in the browser, and then we just play around with this calculator a little bit, and then we'll continue from there. Okay, like I've said, this is not a get-rich-quick scheme. You've got to be consistent. You've got to do the right thing. You expect, just be conservative about expectation. Expect 10%, it could be more than that. I realize more than that on investment, but be conservative about your expectation. And I'll show you where you can put this as we go along in this training. So, for example, the ticker for Apple is AAPL. The ticker is the symbol for a particular stock. And if you do that from 2013 to date, and you put in, if you put in 2,000 and you calculate it, that in your account today will have been $28,000. And that's you not doing anything. This is passive income. You put in 2,000 and you close your platform, you throw away, you keep the password somewhere, and you don't open it again, and you open it today, what will be in your account is 28,000. Okay, this is now a real life example of what has happened in the last 10 years. Okay, and I'm going to just give us a few more examples before I move on. If you had put down money in a Nike, in that Nike, you love the shoe. It's also good that you also love the stock. And B, you know, as you are spending the money, you know, the part of the money you are spending is coming back to you indirectly. Okay, Nike will have given you £7,000. If you put £2,000 into it, a few 10 years ago, it looks small, but look at the return on a yearly basis. You have a 14.5% year-on-year return on what you put into Nike. I'll just run off. Let me do MSFT, which is Microsoft. We all use Microsoft products. Probably have a laptop in the house. You use one in the office. You use Microsoft Word, Microsoft Office. You use PowerPoint, like I'm using today. All of these things, they are collecting money from almost every learned person on the planet today. If you put in 2,000 into Microsoft 10 years ago, you have £25,000 in your account today, apart from dividend that you have earned from Microsoft. And that will give you what? A 29% return on a yearly basis. Okay, a 29% return on a yearly basis. And I'm not, these are not fables. I've already have 100% return on Microsoft personally. So these things are very, very possible. And let's go to Coca-Cola. Coca-Cola, 2,000 for 10 years. To only give a modest return of 4,000, which is still more than savings account 7.8 return on a yearly basis. And I will tell you the reason why it's like that. It's slow, it's steady. During war, people are still drinking Coca-Cola. During recession, people are drinking Coca-Cola. It doesn't get impacted. Or you want to look at Pepsi, for instance. When you look at Pepsi, for instance, okay? And I'll quickly calculate that, and then we'll look at question. Well, Pepsi will give you a decent 11% per annum. And I'll quickly show you a graph to see the reason why Microsoft is what it is, Apple is what it is, and there's stock like Pepsi is what they are. So I've been told I've got questions. Please share the link here. Okay, that the link will be shared. Okay, and then how does one forecast which company? Okay, someone is asking, how does one forecast which companies to buy? I mean, see Apple versus Nike's return. Okay, so you don't have a crystal ball to be able to say this company will outperform this company. But what you're able to do is, I'm surprised about Coca-Cola. Yes, I will tell you why Coca-Cola and Pepsi is like that. They've been around for so long. You know, there are companies who are in their growth phase. They are growing rapidly. There are companies that are already established. Okay, there are companies that are discretionary. Okay, you don't buy them when you don't have money. Okay, and there are some that are not discretionary. You must buy them whether you have money or not. So the way people invest or interact with those companies are different. So quickly, let me just really show us something before I continue. So let me go to finance. This is something that I want us to also know. I'll just compare two stock charts for us. Okay, for instance, this is the market today. It's looking very green, and they're also looking very red. Some places, both red and green. So this Microsoft is down today, down almost 2% today. For instance, look at the chart of Microsoft in the last 5 years. Okay, this is Microsoft. Okay, let's go to Pepsi. Look at Pepsi for the last 5 years. You can see that Pepsi is slow but steady. It's slow but steady. There's inflation outside, and Pepsi is not feeling the inflation. Okay, look at inflation for Microsoft. Microsoft is feeling the inflation. So those that are slow, those that doesn't give you return when it's the time of crisis, they are stable. McDonald's, stable. Pepsi, stable. Coca-Cola, they are stable. Johnson & Johnson, they are stable. Unilever, they are stable. Okay, during crisis, you know, and that's why you need to diversify your portfolio. How do you know the one that will give you 100%? You don't really know. You can look at parameters, okay, And along the line, that you rejig your portfolio, you move money from one to another. Some you will exit, some you will retain. It's always good to have a good reason why you buy something in the first place. So you can see the reason why that is like that. They pay a dividend of 2.6% per annum. Microsoft is paying you 0.8%, but Microsoft is a growth stock. If you look at the way it's moving on an annual basis, you can see from 100 billion to 200 billion within 2 years. Person might have a lot of money, but their margin is not much. Microsoft can have a margin of 30%, where Pepsi is a margin of 5%. Okay, I think I've dwelled on that. So let's move. I believe I've answered your question. Okay, one more question there. Okay, this is something that the fund invested and never touched for years. Okay, so yeah, that means that you put in money and you're withdrawing. You're probably adding to it, or you put in an amount and you left that amount, means you're not withdrawing from that. So as we all know, there are challenging times when cash is required to meet an emergency. We may need to sell some shares at those times. Do you recommend returning the borrowed shared money once they are stabilized? Yes, I would advise. It depends on the account you open anyway. If you're in the UK and you open a retirement account, you can't touch it until you are 55. Okay, because it's your retirement account. That's the SIP. But if you open an ISA account, you can touch it. So you can sell and withdraw money and put money back as you will. But with a retirement account, you can't touch until you are 55, when you can withdraw 25% of that money lump sum out of your account. Okay. Okay, so let's move on. I'll just pick one more. Let me pick 2 more popular ones. Some of them might return negative in 10 years. Okay, and that's why you need to balance your portfolio. It doesn't mean they are bad stock necessarily, but just you being able to know how to diversify in technology. You are in consumer goods. You are in motor vehicle. You are in renewable energy. You are in oil and gas. You are in pharmaceuticals. You are in financials, banks, stock. You are able to balance everything. So let's look at another popular one that me looking at it. Let's look at Meta. Meta is Facebook. Meta platform would have returned to you 17,000, not as high as Microsoft. Let's look at Tesla. Tesla would have returned to you in 10 years 61,000. Okay, and Netflix and Netflix would have returned to you in 10 years a decent 24,000. And there are other ones that are going up right now, like NVIDIA. NVIDIA, I think I've done more than 400%. But let's see what it would have given to me if I had invested 10 years ago, 200,000 pounds. It's just 2,000 because it's done on the average a return of 63% per annum on an annual basis. So that is the power of compound interest. Okay, like somebody asked, if there are difficult times, and that's the reason why we should have a buffer, have something that can last you for 3 to 6 months. Some, there's some issue that will consume those 3 month savings like this in just one month. We know that's life happening, but it's good to be prepared for such. Okay, so I will go back to my slides now. Do you have a question there? Okay, it said kindly share the link to the last website you just demonstrated to us. Okay, okay, I will share that below. You can search for Google Finance or Yahoo Finance or MSN Finance. So Microsoft owns the MSN Finance, Google Finance, or Yahoo Finance. There are places where you can look at the charts. Okay, so so we have, for instance, this is S&P that I said normally return an average of 10%, which is the benchmark for the stock market. Okay, in 2010, 14%, in 2011, 2%, in 2018, minus 4%, 2022, just this last year, due to inflation, minus 18%. Okay, but you can see the years it has returned so well. Now, do you know the year is going to return 31%? You don't know. Do you know the year it is going to return 18%? There is no way for us to know. Okay, but there's something that you can do, which is what I will show you. You can say, oh, market is down today, I will not invest. Market is down yesterday, I know it's red today, so I won't put my money. But look at this. This is one of my portfolios out of like 7 or 8 portfolios that we have. This last year when market did minus 18%, you can see how the market came down. This is my portfolio because I am consistently investing. So what you do is that you look for what you love. When you bought what you love, if there's crisis and what you really love is going down, you let it go down, and then you buy a little more of it. Okay, Microsoft is going down, it will go down, it goes down, then you buy a little more of it. Okay, it goes down, you buy a little more of it. It's called dollar cost average. So you can't predict the market, but you can position yourself to take advantage of the market. So I put all through this place, all through these months, all through 2022, when market was going down. I opened this account November 2021, and from November 2021 till December 2022, market was going down. Okay, and this chart is from November to, now I position myself there. Market started picking up from January. I was able to enjoy the return because I bought those stocks very, very, very low. So when the stock market is going down, it's not a time to say, oh God, my account is negative. I've seen a stock that was minus 30 and it's now positive. That's because I understand the reason why I bought it. And that thing has not changed. So Microsoft went down. Why did it? Nothing happened to Microsoft. Microsoft was still a very, very good investment. But there was a news that there is inflation, and Microsoft share came down due to the news that was happening. Or also let's look at a few charts. Let me go to that website again. Let me go to here and just show us this again. So I'm just going to show a few trends over the years. Let's go to US market. Go to NASDAQ. NASDAQ is technology composite or index for technology company. So let's look at this. So look at this place. The dot-com bubble and bust. This was the dot-com bubble in 2000, and things came down. Okay, but look at where the market is today. Look at the 2008-2009 recession. Market came down 30% generally, but look at where the market is today. Look at coronavirus 2020. Market came down sharply, about 20 or so percent. Okay, but look at where market is today. Inflation came around, market is down. But look at what market has done after, inflation. We are coming out of inflation gradually. And in fact, if there's any time to invest in the market, this is the time to get in, because we are in another bull run. This bull run could go for another 5 years. If you look at the interval, 2000, 2008, about 8 to 10 years, 2020, okay, another 10-year interval. We are 2023 now. Another bull run is about starting. Or if you're out of recession, another bull run could start for another 5 or 8 years, and it could be somewhere here in the next 5 or 8 years. So you don't really want to miss out. So market over the years, the decades, 70, 80 years, it's been recovering. And why? Everybody in the world have their money there. All the billionaires in the world. Go and look at Forbes list. They measure their worth based on how much their stock is performing. All the billions and trillions of billionaires in this world are in the stock market. Okay, they don't want it to go down. They would rather change government policy for it to go up than for it to go down. Okay, so let's go back to the slides. Okay, so you can be consistent, and why you can experience this when a market is going down is because there's consistency, a consistency in my investment. I'm putting in £250 on a monthly basis, putting it into those stocks that I really love. Like I normally say, it means those stocks, they are on sale. Okay. So if Microsoft is down 30%, Microsoft is on sale. It's like you having a bag or a shoe that you love, and there's 30% discount in the city center. What do? You run out tight. You go and cash that 30% discount because it's something that you love to have. Okay, so let's look at the next slide as we move on. So I just want to be sure I'm still okay with time. Okay, we're still very okay with time. Still have a lot to go through. Okay, so I know 2 hours is a lot to make you a pro in this, but we are getting started. It's a place where for us where we can get started. Thank you. So do I have any question there? Okay, are we okay? Okay. So okay. So the next slide is I have questions. Okay. Okay, will I be uploading this session? No, the session will be uploaded. Give us a few days. The other ones we've done, we will upload this session on our YouTube. Our handle is okay. That's the handle. The meaning is I build wealth for generations. That's you making that a confession. I build wealth for generation. For on Twitter, on Instagram, on TikTok, on YouTube, that is the handle on all social media. Okay, thank you for this. I invested in Oram last year. It grew fast, then it crashed at phase 3 stage, but off share, that puts you off share completely. Okay, so I don't know the company called Oramed. Okay, Oramed, it could be a biotech. Now, you know that the companies are in different stages of development. Yeah, I put money in the company before into an electrical company, and that electrical company folded up. Okay, so it's it's about not putting all your money into a single stock. Okay, I have shares in almost 100 companies. It means if one should pack up, I'm not affected. And there's a way you can also, like we have on the screen, let me show us on the screen. You have mutual funds, ETFs, okay, index funds. If you put money in a mutual fund, you are putting money into about 100 or 50 companies at the same time. So if one of them should go up, should pack up, you are not affected that much. Okay, so and then once you bought Oramed, you can also maybe buy 2, 3, 4, 5. I say start with about 5 individual companies, or start with mutual funds, or ETFs, or index funds. Okay, I will probably show us what mutual fund is, and then if you look at these are investment instruments you can put your money into. The big one there is real estate. Okay, because it retains its value. You can see it brick and mortar. Okay, and then, but again, it depends on how much you have. For you to be able to do a buy to let now, you need 25% deposit to be able to start. But with £25, you can start. The ones in green are the ones we look at. Okay, savings or your stock or mutual funds, individual stock, mutual fund, ETFs. Okay, some trade options. I don't trade options. Some buy physical metal. Some people buy physical gold and keep in bullions. I don't do that yet. I hope I can do that someday. Okay, I do real estate and I do the remaining one. I have a startup company. I'm growing. Okay, and other things. Then some people do treasury bills. Like this is common in Nigeria. I understand there are people from America here, people from Canada, people from Nigeria, mostly people from United Kingdom. This principle will apply anywhere you are, except for products that are specific to a particular country. You have about 40-something people online right now listening to me, okay? And so from different countries, this principle applies to anywhere and everywhere you go. So what are those? The summary is what I have: the money market, stock market, real estate, entrepreneurship, and then venturing or angel investing. This you putting money into startups, just like you have in Dragon's Den. Okay, putting money into upcoming companies. Venturing is when you get to phase 4 of investing. It's not what you do in phase 1, 2, 3, because they are high risk, very, very, very high risk. The company can be out today and is dead tomorrow, okay? And that's why we look for companies that have 10 years, 20 years, 30 years, 100 years, 200 years kind of track record. You mix them up depending on the kind of risk level and the kind of growth that you want out of your portfolio. Okay, let's move on and explain shares and stocks. Okay, there's a question there, and I will quickly take a look at that question before I continue. Do you advise to diversify and hold on to shares that include cryptocurrency despite the higher risk as well as more stable shares? Okay, I don't train or advise people to buy cryptocurrency. Let me see, but I do have cryptocurrency. That's me, and it's 0.00% of my portfolio. I think I have it on one slide here. Yeah, I have it on this slide as a disclosure. I don't advise people to buy cryptocurrency or to, if you have cryptocurrency, just see it as one of those things. If it comes, fine. If it doesn't come, it's not the end of life for me. If I lose my 200 pounds, it's not. Maybe it's around 250 now. It's not the end of life for me. It's 0.000 whatever point of what I have in investment. Do you understand? And so we don't do day trading, and we don't do crypto. Okay, and the reason why I don't do day trading is not investment, and it's not passive income. You have to trade every day to make money, and it's very, very high risk. Between 70 to minimum of 70% of people that trade lose their money. This is fact. I can show you on the internet, on all the trading platform in the UK. 85%, 70% of people that trade, they trade on currency and on indices, lose money, and it's not investing. It's not passive income. Okay, so I'll quickly go back to where we were. So here, so stock exchange. Okay, so what is a stock exchange? A stock exchange is just a market where you buy and sell securities like shares, bonds, ETFs, and the rest of them. Okay, we have London Stock Exchange, we have New York Stock Exchange, we have NASDAQ. We were in America earlier in the month in New York, and I say, okay, we must go to NASDAQ. We went to NASDAQ in Times Square, went to where else? We went to what do you call it? New York Stock Exchange, and that is where you have Wall Street. Went to Wall Street and the rest of them. So you have NASDAQ for technology, for tech, majorly tech stock. You have New York Stock Exchange for other stocks. You have LSE in London for London Stock Exchange. You have CAC for France and DAX for Germany. You have Nikkei for Japan and the rest of them. There are different places where you buy and sell securities. Okay, and then I think I put in here. This must be a draft page that I didn't complete. Okay, these are S&P. Oh, okay, these are the components. The component of S&P. 500 companies that make up S&P. Okay, investment platform. So we know there is a marketplace where you go to. Now, how do you connect to the marketplace where you can buy and sell securities, shares, individual shares, or mutual funds? Okay, you need a brokerage account. You need an investment platform. It could be these days you have a app that will help you to connect to the stock market to buy and to sell securities. Okay, and I will just go through a few of them. And then depending on the country that you are, you know the one that is very popular in your country. I will explain the one I used in the UK. I've done my research, and I can say these are the ones that I used in the UK. Like I've said, this is not day trading. This is investment. This is you becoming a shareholder in a particular company. You have voting rights. You have dividend as a shareholder, no matter how little that you have. So, investment account. Investment account, before going into the apps that you can use, these are investment accounts. These are particular to United Kingdom because these are government's kind of initiated products in the market for United Kingdom. There will be the one like 401k in America and the Roth IRA in America, and every country kind of have their own kind of investment portfolio backed by the government for pension funds and that are tax free. So there are children investment, young adult investment, there are ISAs for everybody, there are SIP, self-invested personal pension fund, a premium bond in the UK. Any of these you can start with as little as £100 or as little as, and in fact, lower than £100, and you can use to start any one of these. Okay, like I said, day trading excluded, crypto excluded intentionally because they are high risk. It's not government regulated. Trading is regulated, but in fact, in the UK, you don't pay tax on trading because it's called spread betting. Is very high risk investment. Or when I started trading, in 2026, I was trading, and like I said, I lost close to $25,000 trading before I knew that I was making a mistake, that I should be investing. When I started investing, the game changed, and I can see the return on my account today. Okay, the first account that I would explain to us is what you can open for your children. Okay, this is called the Junior ISA. Okay, it's for people who are under 18. It's for people who are still under 18. You can do savings towards their college, towards their first house. I explained during the compound interest calculator demonstration. Before they are 18, with $200 in that account could be enough for them to pay off their university fee and to buy their first house. You can buy shares and stock and mutual funds into it. We also have cash ISA, but we know return on ISA is level 5%, even with the inflation is around 5%. It's not still as high as what you could probably get from from the stock market. A minimum of $9,000, maximum of $9,000 you can put into Junior ISA in a year. Okay, anything you make on it is tax free. Okay, and then when your children turn to become 18, they can take over the account, and then you can start with as little as £100. These are companies that we have in the UK that you can use to start. I use hl.co.uk. If you go on that page, you can read more about it. Okay, and the next one I'm going to explain is investment for young adults. If you are between 18 and 39 and you live in the UK, you can open what is called Lifetime ISA or LISA. Okay, it's a savings towards your first house. If you don't buy house with it, then you leave it until your retirement. Okay, so that you are pulling money out of it after 1 year of starting it to buy a house, or you leave it to your retirement, either of the two. You can put a maximum of $4,000 per tax year into it. It means from April 6 to April 5. UK tax year is April to April, okay, not January to December. So from April 6 to April 5, you can put £4,000 into it, and any money you make on it is tax free. Okay, you can buy a house that is up to $450,000 from your LISA. Okay, and then your LISA form part of your $20,000 annual allowance. I will explain that. The $20,000 allowance is what you have on your ISA, which is the one for everybody. For ISA, I will get there. You can put in $20,000 in a particular financial year into it. But if you have a LISA and a ISA, you can put $4,000 maximum into your LISA, and the remaining $16,000 into your ISA. Okay, on that link with hl.co.uk, you can read more about it. Okay, then the next account I'm going to explain is called Junior SIP. This is purely a retirement account. How are we doing for time? This is purely a retirement account, and then with that, okay, thank you. And with that, you are able to start a retirement account even for a child from zero to 18. You can have that Junior ISA when you are still below 18, and you can keep it until retirement. That just means you're probably going to have an early retirement if you do this right. You don't have to wait till you are 65 or 67 or whatever. They're taking it to maybe above that. Who knows? Because there's pressure. People are living longer. There's pressure on the pension funds and on the government. And so they could increase the age at any time. Okay, you can take over the account when you are 18. If you're still under 18, if your parents should start it for you. Profit made is not tax, it's tax-free. at 55, you can withdraw. You cannot withdraw until you are 55. You can withdraw lump sum of 25% of your account when you are 55. So those are retirements. That's a retirement package. Okay. The first one, the LISA, is not retirement package. You can buy a house with it. The ISA is not retirement package. You can withdraw from it at any time. Okay. And then the next one is the ISA. ISA, you can put money in, you can withdraw money anytime. Okay. And then you have a 20,000 tax allowance in a year. That money, that 20,000 can go either into your LISA, into your innovative ISA, which is you putting money into REITs. These are real estate investment company, or into your lifetime ISA, or into your bank cash ISA. You can divide your 20,000 between all of them. Okay. And that also is tax-free. You must be 18 and over to be able to do that, and that's general for everybody. And you can only have one ISA account. You can only put money into one ISA account in a particular year. Okay. If you want to move to another company with your ISA, then you stop putting money at the end of by April 5, you stop putting money into one and you move to another one. For instance, I started a new ISA account with another company April this year. Okay, I was using one for the last for years, but I've stopped putting money into it. I moved to another one from April this year. So my money is still in the old one, but I can't add money into it in this particular financial year until after April 6 next year. Okay, and the next one is a retirement account. And so this retirement account also, government will put money into it. Okay, it's like government returning your tax back to you. So if you put £100, government will add £25 to it. And then you can trade with government with that money on for the next 20, 30 years, depending on when you are going to retire. Okay, so government can even put up to 45% for like myself. I'm a higher rate taxpayer. I go to my accountant to claim back the remaining 20%, because government will automatically put into your investment account with your company. The government credit your account, your investment account with 25% of anything you put into your SIP on a monthly basis. If you're a higher rate taxpayer, your accountant will claim the remaining one for you through your self-assessment, and government will send a check to you for the remaining part. So it's more like you getting 45% back of what you are putting into your investment, which is a lot of money, and that you being tax efficient and trading with government's money. Okay, so you usually pay. So you can put up to 60,000 across all your pension, both your workplace pension and your SIP pension. You can have multiple SIP with different companies. There is no limit to how many SIP accounts you can have, plus your workplace pension. But the amount you put into it in a year is 60,000. If you earn 60,000, you can put the whole of 60,000. If you have another means of sustaining yourself, you're allowed to put maximum of 60,000. It could be 100% of your income. It means you don't have to pay any tax at all, if you can still survive with that. Okay, so and those are the investment accounts that we happen to have in the UK. My personal example is I've got SIP, I've got two SIPs, I've got ISAs. I've invested in it's more than this now, about 61 US companies, about 18 UK company, and about 1 European company. I do more of US company because that is where the money is. About 20 mutual funds. So I'm kind of well diversified. Whether market is up or down, I don't really care. I don't really feel it, because if one sector is down, the other sector is up. If a sector is up, they can all be up at the same time. It depends on how the news or what is going on in the market. And so I put a slide here. It said the best time to plant a tree was 20 years ago, and the second best time is now. Okay. You wonder, why have I not done this? Why didn't I have this information years ago? But you have it now. Okay, I didn't start 15 years ago. I didn't start 20 years ago. I started like 6-7 years ago. And I've been able to build a portfolio in tens of thousands. So you are able to start today. Start with what you have, where you are, and start today. Okay, and so I will just show us a few a platform that we can use. So in the UK, I use this too. Okay, and I have my reasons for. I've gone through the market. To be honest, I've selected the one that I think are the cheapest, that offer the most features for me. So in the UK, download the app for hl.co.uk. I would say also subscribe to Freetrade, and I'll show you a few from other countries. If you're in Nigeria, I've heard about all this. I've not used any one of them before. That would be my disclaimer. I've not used investment app in Nigeria before, okay? But these are some of them that are very popular. I've heard about. A lot of them are startup companies. Or so that you go to your broker directly, get a broking account with a stockbroking firm, or you use the app. Some broking firm in Nigeria will only buy stock for you, Nigerian stocks for you. But some of these apps can buy American stock for you, can do what is called fractional investing. It means you can buy a fraction of a share. You can put in as little as $10 to buy through this app if you live in Nigeria. If you live in the United States of America, these are the common ones. We have the new company coming up, like Webull is a new company, Robinhood is new, Sophie is new, but you have the big ones like Vanguard. They are more like the king or the father of ETFs. You have TD Ameritrade, Fidelity, E-Trade, and the rest of them that you can just do your due diligence locally and see the best that you want to use at the local level. And if you're in Canada, these are the ones that came up when I was doing the research: Simply, Web Simply, Qtrade, Questrade, Interactive Broker, and TD Ameritrade Direct Investing, and the rest of them. These are platforms available. I'm just trying to cover the audience of people that I know I have on the call tonight. Okay. So you can do your diligence. These are the sources of where I got those information, where I got the information from. Okay, so back to what we have in the UK. So okay, so we have here I've compared, we have comparison of 4 of them here. So I've chosen to use Freetrade, and the main reason is that every trade I take on Freetrade is free. Okay, every trade I trade, and because I could in a day buy 10. Okay, I hardly sell. I could in a day buy 10. Once I move money into my account, I kind of use that money to buy things almost immediately, and so I don't pay anything for every transaction that I do. Okay, and then there's a basic plan, which I said don't apply for basic plan. Okay, I will show you the ones to apply for. Don't apply for basic plan. Any money you invest on the basic plan is taxed. Is a normal investment account. It's not SIP and it's not ISA. So any money you make on the basic plan will be taxed. Okay. Then you have fractional shares, and this is one of the things that got me. The reason why I chose to have Freetrade. You can buy fractional shares. What are fractional shares? Let me just really show us an example of what fractional shares are. Because if you look at the market, let me go to finance. So this is my watch list. So let me sort it by price. You can see that Costco, to buy a single share of Costco is $561. ServiceNow is $560 for a single share. Adobe, the one that knows Adobe Reader, is $513 for a single share. You can see NVIDIA $400. You can see how expensive they are. But what fractional share will do for you is to buy five pounds or $10 of this share, and they give you 0.00% of a single share. Okay. Traditionally, before now, all you can only buy at least whole number, 1 share, 2 shares, 3 shares. But now you can buy fractional. You can buy fractional shares, and so that's what you enjoy here. You can put 20 pounds into a stock. You can put 100 pounds into a stock. You can put 10 pounds into a stock. But HL and the rest of them, the very established ones, they don't have it. These are also some of the new companies we have in the UK. So Agrips, Lansdowne, HL is the biggest of them. They have billions and billions under management, but they don't have fractional share. And for every single trade you do, you pay almost 12 pounds for it. But there's a place for HL, as I will explain to you. So these two, I will say these are the things, the two that I use. You can also choose to use them. So the reason why I said don't do basic account is it gives you a general investment account on Freetrade. it's not tax-free. Anything you make on this account, I made a mistake of opening this account before. Anything you open on it, you'll be taxed. So if you open the £6 a month account, you can only do ISA on it. You can't do SIP. You do the £12 a month, you can do both ISA and your pension account, self-investment, invested pension, personal pension on it. So I have this type of account. Okay, so I've added another slide. So I'm comparing. So if HL and Freetrade, which one? I would say have both of them. And these are my reasons. Sorry, I didn't put the heading. Apologies for that. I can just quickly put it now. So this is for HL, the first one, and the second one is for Freetrade. Okay, I'll put that back up again. So this column is for HL and this column is for Freetrade. So for HL, there's no monthly subscription, but you pay 11, almost £12 per when you buy and sell. They don't have fractional shares, so I don't use it, but they have mutual funds. So if you are just starting out, you want to start with mutual funds, okay, I would say open HL account, especially when you have just £100 per month to put into your account, okay. Start open HL, put £100 into mutual funds on a monthly basis. You don't need much decision to do mutual funds. They are basket of shares, okay? Okay, they are basket of shares. If you use Freetrade, there's a monthly subscription, but there is no dealing fee. For instance, if I buy 10 shares, 10 different companies in HL in a month, that'll be 10 times 12. I've spent 120 already for fees, whereas I only pay £12 here, and I can do as many trades as possible. There's fractional shares here. They don't have fractional shares. They have mutual funds. They don't yet have mutual funds. They are working on it. Okay, so I buy mutual funds here, and I buy individual stock here. I also buy individual stock here because of other reasons. Okay, I already have an established account here. Okay, but if you're going to put in more than 150 into your account, I say just go for Freetrade, and then pay the monthly £12 in addition to that, and you can have your enjoy fractional shares. But 150 is too small to buy individual shares. Some of them are small. Coca-Cola is less than £100 a share. You can buy one of it, but if you buy a Coca-Cola of $60-something, you are paying $12 on it. So you rather do it here, okay, on Freetrade. Okay, how do you open those accounts? They are here. I can put them in the link. But if you go on the website, you also see how you can open them. I want us to take action. I put that in the link. I want us to really take action after this class. Okay, I think I already have a few questions waiting for me. Is that okay? Okay, I'll just take a few questions. Any comment on E? Okay, now, okay, eToro, IG, they are for trading. They are not for investments. Okay, they are majorly trading platforms, day traders. They are not investment platforms, okay? To want to day trade, you can't use HR to day trade, you use IG or eToro. Okay, is it possible to have access to the video? Yes, it will be on YouTube. I'll be work for generation YouTube, okay? Is it possible to access the video? Yes. Is it possible to, yeah? The video, yes, it's possible. Any advice on how to avoid huge inheritance tax for our children? I would say I'm not an expert in tax, so I won't have enough time to be able to discuss that now. You can pass on your ISA, you can pass on your SIP to your children, but the tax implication, tax keep changing in the UK. So for that, I would say it's good you consult a tax accountant to put something together for you. Okay, I will go back to the slide as we have a few minutes left. I'd love to respect people's time. Okay, mastering the art of picking stock. I will go through that. So every one of us, the first thing you want to do now is to create a watch list. That's where you start from. Open an account, download the app, open an account, create a watch list. go to google.com/finance if you have then log in with your Google account, or go to MSN, log in with your Hotmail account, or go to Yahoo, log in with your Yahoo account, and you're able to create a watch list. And I've told you how I've shown you my watch list. This is my watch list, okay? These are things I already have. This is the one I'm looking at. I'm watching the one. These are the ones I'm actually looking at right now, whether to buy or not to buy. These are watch lists for dividend stock. Some they pay as high as 10% per annum. These are UK stocks. UK did very well today. These are UK stocks. And create a watch list. If I pick, let me pick this account for instance. Look at this is blank. So if you log in, you see something like this. Then add new to your watch list. You can name your watch list. You can say maybe things to buy, whatever. You can say maybe they are big. You can call them big cap. Big cap means very big companies. You can create a watch list, big cap, and then you can add investments. Okay, to add investment, you click on that, you look for, to add Apple, for instance, you look for that, and then you add it. So I now have Apple on my watch list. Okay, so you create a watch list, and then when you click on it, you can see a lot of things about the company. You can compare them with other companies. How do they compare with these other companies? You can do that. You can go down, look at financials. We get there on picking stock. So that's create a watch list and start adding things of interest. Be curious. Look at the company supplying that your company is working for, supplying your company. Be curious. How did I buy Microsoft? I work on projects. Why did I buy ServiceNow? I work on projects, deploying ServiceNow. Okay. Why is this company? Everybody is using this company in London. Every corporate Fortune 500 is using this company. Why? So I went, I look at their financials. I decided to buy it. Microsoft, everybody using Microsoft. Why? I look at their financials. Okay, McDonald's, you see a queue there every day as if they are putting something in the food. Then go and look at it. What are they doing that other people are not doing? What are the new companies coming up? Disrupting company. There's flying taxi is coming up. Electric taxi is coming up. What are the people who are doing this? Who are the company of the future? Okay, you look around you first in picking stock. You don't know which one will do 400%, but look at the fundamentals. Read what experts are saying about the stock. Okay, look at the rating of the stock. Is it a buy? Is it a hold? Is it a sell? Okay, look at their financials. When you have a conviction about it, then you do bite-sized investment. You buy it gradually. You don't just put your money into it. You put £1,000 into it, 500 into it. I normally start with £250. If I'm on HL, if I'm on a free trade, I start with £50. I put £25, £50 into that stock, and then I buy in as I gain confidence in what they are doing. Then later you consolidate and increase. You consolidate and increase your investment in those funds. Okay, and then that's about what I will talk about investing, and I move on to savings. For my savings, I use NS&I. NS&I is a government-backed savings scheme. You don't get paid any dividend. Dividends are distributed randomly. Based every pound you put in it can win a dividend or a reward for you up to £1 million. So like I told people, like I normally tell people, if you have a money you want to use in the next 1 year, in the next 2 years, don't put in the stock market. Okay, stock market is not a get rich quick way. Okay, it's you building wealth over time. Time and compound interest works for you when you do investing. If you have your house deposit, you want to buy your house in the next 2 years, please do not put in the stock market. Put in a fixed ISA account, or put a cash ISA account, or put in NS&I, where you have the possibility of getting £25, £50, £100, £10,000, £50,000, £100,000, or £1 million on every single pound you put into it. Okay. Then the next thing is real estate. Okay, another way for you to build wealth for generations is real estate. It is a very, very wide topic, and I won't be able to go deeper into that also. It's something that I also do, and I think whatever I put in the market is like 10% of what I have in real estate. Okay, as good as the market is, as good as stock market is. Okay, so you have here the advantages is that you can leverage, put down 10%, you get the remaining 90% financed. You put down 25%, you get the remaining 75% financed. There's capital appreciation, there's rental cash flow, there's equity release from one house to buy another one. It's a physical asset you can touch, it's brick and mortar, okay? And then there's housing shortage in Nigeria, not just in Nigeria, in the UK. Everywhere in the world, there is housing shortage. Land is limited in supply. Land does not grow as much as human being has been given birth to. Okay, so real estate will always be shortage of housing. Diversification, as you go to diversify your portfolio, is also a store of value during inflation. So I have here my personal example of an investment of 10,500 about 2010, about 13 years ago, and that investment is worth up to $500,000 today because I will release of equity to buy another one, which is now that 170 is now worth 140, and release of equity on this one is now worth this. So this 10,000 has generated up to $500,000 within 13 years. So that's another way for you to build wealth. Going into it, we have 10 more minutes to go. So I've just decided to have that summary there for us. Don't wait until when you can afford a mansion. Okay, don't wait until when you want to buy a. I know you deserve a mansion. Okay, you deserve a 4-5 bedroom house, but don't wait until then before you buy your first house. Don't keep paying rent and keep paying someone else's mortgage. Okay, start from somewhere. You can always move. When you move to another house, you rent out the first one you started with. Okay, you can always do that. And the next one is entrepreneurship, which you can start. Like I said, I'm also a founder of a startup company. Building gradually, it's not profitable yet, but it has the potential to become profitable. And so you can choose to have a side hustle that becomes a business. There's a lot of side hustle out there that people also put money into. Get a profitable one, don't waste your money. Get a profitable one that will bring you something, no matter how little, on a monthly or daily basis. Like I said, we are all in business. Our current employer is our first and only client. And so you can turn your skill from being employed to become self-employed, to become a business owner, and replicating the same thing you do for your employer right now. How can you replicate the same thing for a lot of people working for yourself? Okay, you selling information, whatever it is that you can package together that you can sell. And these are the things you consider when you are building a business. You need a very good idea. You are solving a problem. You don't get paid for opening a shop. You get paid because you are meeting the need of people. Put together a business plan and be able to sell, and sell. Okay, so we have 7 or so more minutes. Okay, so we have questions. You have questions now. You can unmute. If you want to unmute, you can type. You want to type. So I'll look at the chart. Meta shares on my mind. Good. Yeah. Yeah, I've got some of some Facebook share. But you look at the financials and be sure you are still okay. I can see a hand up. Can Richard please unmute and let me see.
Yeah. Hi, it's Richard here. Can you hear me?
Yes, I can.
Yeah, I just want to say, I guess it's my own contribution. Is with the way interest rates are now in savings, that's another way people can save a bit of money. Make a bit of money. It might not appear much, but it's worth ditching and switching. So some of the banks are giving up to, I think it's 5. There's about 4.5 to like 5% interest rates now. Yep. Some pay monthly. So like I just opened one with Shawbrook. Shawbrook is the latest one now. So what I do is you put the money in. You can either pull out the interest they pay monthly, but I realized compound interesting, leave it there, and then let it just keep, building. I looked at for my Chase account, what I had before. And money I was just keeping there. Every month I realized I was getting about 35 pounds. It looks small, but over a period of, say, like a year, look at 35 pounds times 12 compared to just leaving the money sitting down somewhere where it isn't earning. So right now, interest rates for borrowing is going up, making it difficult to borrow. But then same thing, interest rates in savings are going up. So people, we can use that, take advantage of this, move the money around. If after a year, whatever you make, look for the next person who's offering better, move the money around that way. You know, it's a simple way to also start and end something.
Thank you very much for that very important contribution. Some fixed accounts maybe ISA might not be that much, but some fixed account in savings can give you as high as 5% because the interest rate is very high now. Okay. So any other question I've seen here? Okay, please can you quickly share on how to take my cryptocurrency out of Luna? I've not used Luna app before, even though, like I said, I have crypto. I use Coinbase. You can sell and pull out. If you go on their website, they will be able to explain to you how to pull your money out. Okay, do I just leave it as Naira even though I no longer live there? Okay, well, if you're able to pull it back into your Naira account, then you can convert and there's nowhere to put it then. I've not used Luna before, so I'm not too sure of their withdrawal policy. Okay, how about rent-to-rent property investment? So like I said, rent-to-rent is another means, property is another means of making money. That rent-to-rent involves a lot of work. You've been able to negotiate deals with people who have houses and being able to negotiate the deals with them to be able to, you rent from them, and then maybe you rent a 3-bedroom house, okay, and it's 800 per month for the landlord. You convert it to multiple occupancy, turn the sitting room to a room, make it 4-bedroom house, give it out at 500, meaning giving you 2,000 and before cost on a monthly basis. You give the landlord the 800 because that's what you promised them. You keep the remaining 1,200. You remove your cost from it, and then you make a profit. That's what rent-to-rent is all about. Yeah, but it requires you being able to negotiate deals. And I have not done that before, so I won't be able to speak too much to that. Okay, I have ISA with Vanguard, but I think they only deal with ETFs. How can I start buying individual stocks? So if you want to start buying individual stocks, at Vanguard, they're the king when it comes to ETFs. You can open, depending on the country you are, you can open HL account. You can open other trading account in your country. Okay, thank you very much. So for that question. So let me go into, like I said, I can probably make you a pro in 2 hours. And in the remaining 3 minutes that we have, these are the next steps. Create a budget if you don't have one already. Don't forget to add yourself as part of your expense item. Pay yourself. Create an action plan to become debt-free if you are not yet debt-free. Set up a standing order to pay yourself into your investment account. Open an investment account, an ISA or a SIP, or what if you don't already have one, or whatever you have in your country. Invest into your first fund or share, or your first fund or your individual share. Register for further education. And that's where our master class is coming. Reach out for any assistance if you need any. And so I'll just go to the next slide. So we have also put together. So Richard, I can see your hand up. Give me a moment. So yeah. We're also having a master class. It's not possible for me to make you a pro in 2 hours. So I think what I've done is to get you started. Go and start. But for you to be able to have deeper knowledge of this and see a stock and whether to buy Coca-Cola today or not buy it, or buy Facebook today or not buy it, let's go deeper. We'll be doing technical analysis and fundamental analysis of stock before you buy them. We look at deeper into ETFs and mutual funds. We formulate a strategy. I'll share your strategy. The strategy I use, I'll share with you. There are practical sessions of going through all of these things one by one, analyzing stock together. And the best of it is that we form a community on Discord. Discord is a community where you can come together, chat together, and it's not WhatsApp. It's a place where you can post. I can post what's happening on a daily basis, and that is what 1,000 or is worth a lot. It could be between you making money and losing money. And so when you come around, talk together on a daily basis, other people come around and share their own opinion and their own and what they are buying and selling. You are able to gain from that community if you come for the masterclass. You can leverage on our experience, and then I will share my portfolio strategy. I share debt management and debt repayment strategy, and then I will share more reasons why I don't day trade or do crypto, and then I will go into my property investment journey, and where we are in our property investment journey today. To do that, go on the website where you register from, and then go on seminar. You see, masterclass is £250 to come around. We spend like 5-6 hours together on a Saturday doing this, and in the evening on the Monday we do some practical also, and then we join that Discord. We discuss on a daily basis on what to buy, on what not to buy, and then we just share knowledge together generally. So I've invited you, and it's going to happen on the 19th. One on the 19th of August, and another one will happen in September. But make it to the 19th of August, and then we can share that knowledge together. Okay, let's handle more questions now. Richard, please.
Yes, I was going to talk about rent a room. Okay. With the UK, here in the UK, we've got an allowance of 7,500 tax-free. Mm-hmm. So if you've got a spare room where you're not, no one's using it, you can get in lodgers, and you get a lodger's tenancy agreement and all that stuff, which is very, very helpful. I even advise those maybe coming to the UK newly, if you can afford to push it a bit. I know you might want to rent a 2-bed, but if you can push it, rent a 3-bed, and then you've got a spare room where you can get somebody else in. Right now, houses to rent are very scarce. Some people are coming in as maybe just students or single people. You rent that room and you can get as much as 7,500 a year, tax-free from the government. You don't even have to declare it on your tax stuff. I've tried it and I was getting 450 a month. Right now, I hear rents are even more expensive. So you can get good money from having the rent a room scheme.
Okay. Yeah. Thank you for that contribution. When we go deeper into real estate during the masterclass, we'll explore all these options that are available for real estate, from doing the standard buy to let to rent, and then to bringing a lodger, to Airbnb, and to the rest of them, which we can take advantage of. Okay, do I have any other question? Okay, any other question there? Let me check. Okay, no new question. I appreciate your coming tonight. I want your feedback. If you have any feedback, please email us, put in the chat. We appreciate that you're able to make it tonight, and I will be expecting you in that masterclass. Let's go on this journey together. If you're ready to make money, ready to do this big time, no matter where you're starting from, we can grow together. I have an account I just started in April this year. You can start your home, we can grow it together, and then we can compare notes in the next 5 or 3 years or 10 or the next 5 years. Thank you very much for the hand. Do have a very wonderful evening.